branch manager. I have loan officers working with me. The only reason why I put this together, of course, is for you to know me and for me to know you. You know, I don't want you to replace your lender either. I would just want you to consider me. If you need a second opinion, I always say, if you need a second opinion, let me be your first choice. That's all I'm asking. You understand? So that's that. Now, I want to recommend that you don't write anything that is on the screen. Okay, write only the comments that I make, because those are probably not going to be on the screen. You will get this presentation. You will get a copy of the entire presentation. This presentation that we're going to go over 8 hours right now, you get a copy of that so you can take it home and watch it as many times as you want. You will get copies of all the information that I'm going to, everything that I provide in the presentation, don't even ask me, okay? You will get it, because everything that I have, I'm providing to you. You're going to get all copies of all the marketing materials. You're going to get all the scripts and dialogues. You're going to get all the forms, and of course, you're going to get the calculator, etc., etc., etc. And this is where I plug in my joke. All of this for $19.99. I'm just kidding. I'm just kidding. I'm just kidding. Like I said, I'm not a professional coach. I'm not here to enroll you into a month by month, coaching system or anything like that. Not at all. Okay, before we start, I need to clarify a couple of things with you so you don't get confused regarding this. What is Fannie Mae? What is Freddie Mac? What is a servicer and what is an investor? Those are important things that you need to remember. For those of you that don't know what that is, I'm going to explain them to you right now. Fannie Mae and Freddie Mac. Fannie Mae and Freddie Mac were government agencies that were created to bring money into the market. Why? Let me explain you the reason why. Treasury Department, our Treasury Department prints money. They're in charge of printing money. So you can go to a treasury and they actually have tours where you can see people actually printing money, right? Now, this money that they print, they cannot just give it away for free. They cannot just open a corner store and say, hey, free money. Step in line and get some money, right? That's not the way that the economy works. So what they do is that they actually sell the money. They sell the money at a certain interest rate. And who buys that money? Mostly banks. Mostly banks, insurance companies, and so on. They purchase the money from the Treasury Department, and what they do is they resell the money to the consumer, and they charge an interest rate for that. Let me give you an example. Let's say, for example, the Treasury Department is selling $1 million for 1% interest rate. Bank of America will purchase that $1 million at 1% interest rate. They will turn it around and they will sell it, or they will lend it to you at a 5% or 6% or whatever that is, and they will keep the profit. Do you understand that concept? It's pretty simple, right? Well, that's how it works. Now, Fannie Mae and Freddie Mac were created to bring money into the mortgage market. Then here comes the servicer. Who is the servicer? The servicer is the bank. When I say servicer to you, you have to understand that's Bank of America, that's Wells Fargo, that's Chase, that's all the other mortgage companies. Those are the servicers. This is exactly what happened. Let's say, for example, ma'am, that you come to me and I'm Bank of America, and I have $1 million in depository accounts, right? Then you come to me and you say, well, I need $1 million to buy my house. You will get pre-qualified, you approve for the loan, and I'll give you $1 million, and I'm going to charge you interest, right? Now, I, Bank of America, I'm out of $1 million. I don't have $1 million anymore, right? Because I gave it to you. So what I'm going to do is I'm going to go turn around and I'm going to sell that promissory note, that piece of paper that you just signed promising to pay back $1 million. I'm going to turn it around and I'm going to sell it to Fannie Mae. Fannie Mae is going to charge me a certain interest, let's say 3.25%, okay? And I sold it to you for, let's say, 5%, so I'm making 2.25%. Now, Fannie Mae goes and says the following. Well, Fannie Mae says, we're not in the business of banking. We're not even in the business of taking care of consumers for the most part. So they come back to Bank of America and they say, if you, Bank of America, take care of the consumer, you bill them, you send them their monthly bill, you take care of their questions, etc., we are going to pay you a servicing fee. So they pay them a servicing fee. So they get, a certain amount extra for that. Okay, and that's why they call servicing company. Now, who is an investor? An investor is the person who actually, other than Fannie Mae and Freddie Mac, because Fannie Mae and Freddie Mac are not the only investors for mortgage money. There's also other investors. We have private investors as well. For example, AIG is one of the biggest insurance companies in North America. They are one of the biggest buyers of mortgage securities in the United States. We also have private investors. Let's say, for example, the King of Persia comes to the United States with $4 billion, and he says, well, I want to buy some mortgage securities. So he will go ahead and buy some securities. In that case, we will call that investor a portfolio lender. A portfolio lender is the person who buys mortgage securities, but he keeps them for themselves. He doesn't resell them in the market. Okay, so that's what we call a portfolio lender. Okay, I hope I'm not losing you here. There's other investors such as countries. As a matter of fact, Netherlands is a country that that bought a lot of money in mortgage securities. Greece bought a lot of money in mortgage securities, and now they're in trouble because the entire economy depends on the mortgage securities that they bought, which right now, of course, are upside down. So those are the investors. Now, in order to participate, and the reason why I mentioned this at the beginning is because in order to participate in the HAMP-HAFA program, the loan modification and the short sale program, the mortgage security, the promissory note, needs to be owned by Fannie Mae, Freddie Mac, or the servicing company needs to be participating in the program. And I say to you here, links are your friends. When you get the step-by-step guide on how to do loan modifications and short sales, anything that you see that has an underline that is in blue and has an underline, just click on it and it will take you to the place where you need to be. In this case, if you click on does Fannie Mae or Freddie Mac own my loan, I'm not going to do it because the internet connection here is really slow. So I don't want to waste any time on that because we have a lot of material to cover. But if you click on this link here, it's going to take you straight into the website where you can check, by putting the property address, you can check whether or not Fannie Mae and Freddie Mac owns that particular loan or not. Now the second part of it is my servicing participating. 89% of servicing companies are participating in the HAMP-HAFA. There are some of them that are not participating. It's particularly the smaller companies, like you have Greenbank Financial or Evergreen Financial or something like that. Those companies may not be participating in the program, but the big companies, all the big banks are participating. Like I said, 89%, that means 9 out of 10 banks are participating in the HAMP-HAFA. Here's the thing, the mortgage has to be owned by Fannie Mae, Freddie Mac, or the lender has to be participating. It's one of the three, not 3 out of 3. That doesn't mean that if the loan is not owned by Freddie Mac, Fannie Mae, and the lender is participating, you're not going to be able to do it. It's 1 out of 3. So as long as it's owned by Fannie Mae, you're okay. As long as it's owned by Freddie Mac, you're okay. As long as the servicing company is participating, then you're okay. Okay, so far so good, right? Let's move forward. Okay, before we start, how did we get here and where are we heading? How do we get here? Well, the stated income loan and the option arm or the negative amortization loans. I'm going to explain to you because we have half of this classroom here. It started after 2007, so you may not be aware of some of these products. I'm going to explain them to you as easy as I can to try to explain to you how they work. The stated income program. A lot of people think that the stated income program is something new that just started in 2002. In reality, it hasn't. The stated income program started almost 20 years ago. And this is exactly what happened. The banks, in order for you to approve for a mortgage, you have to qualify based on your income, right? Now, self-employed people, such as yourself, business owners, such as ourselves, okay? When we do our taxes, we deduct all of the business expenses from our income taxes, and at the end, our adjusted gross income is lesser than what we actually made. Let me give you an example. Let's say, for example, that I made $140,000 a year, which is an average of about, let's say, about $11,000 a month, okay? So I made $11,000 a month. Now, would you agree with me that if I made $11,000 a month, I can qualify to buy a home in which payment is about $3,000 a month? Would that be okay? $11,000, $3,000 payment? That's so fine, right? So far, so good. But here's the problem. As a business owner, I get to deduct all my expenses from my income taxes, and I report that instead of making $120,000 or $130,000 a year, my adjusted gross income is only $40,000 a year. $40,000 a year represents about, I don't know, $3,000, $4,000 a month, right? Now, with $3,000 or $4,000 a month, now do I qualify to buy a $3,000, $3,000 per month monthly payment house? I don't. I no longer do, right? Now the banks, they said to themselves, well, there is a market out there that we're not touching. The market of the business owners, the market of the self-employed people. How can we touch them? How can we do this? And they started developing a book. There's actually a book for that. There is a book that separates all the categories of employment, of self-employment people. There is actually a book that you can open and you can look for real estate. And it says real estate property manager, real estate investor, real estate here, real estate there. And every category has an average, a U.S. average of how much income they make every year. Let's say, for example, for real estate is about $120,000. So real estate in general, on average, in the United States, they make $120,000 a year. So they started utilizing this book and they created what we call the stated income program. The stated income program is basically you stating on a piece of paper how much money do you make. And they will not look at your income taxes, they will not look at your paycheck stubs, they will not look at your P&L, they will just take it for granted, basically. Of course, they will verify with the book, against the book, you know, if that amount is kind of the same of what you reported. So if you reported 120, they'll go to the book and say 120, okay, looks fine to me, let's move it forward. Whatever your adjusted gross income is, they don't care. And that's the stated income program. Now here's the problem though, with the stated income program, that some people started abusing the program back in 2002. Back when they opened the stated income program, some people started abusing it. One of the biggest examples that I have, or the best examples that I have, is when I was doing a loan modification. I was processing a loan modification package about 3 years ago for this guy, and I needed to see the original documentation for the loan when he got the loan. So he brought me over the 1003, what we call the application. And the application now, mind you, this guy cuts grass for a living. That's what he does. And his income never goes over $3,000 a month, right? In the application, his title was landscape engineer. Okay, landscape engineer, and he was reported to make about $9,000 a month. And the guy doesn't make $9,000 a month. Now, with $9,000 a month, in combination with a negative amortization loan at a 1% interest rate, he qualified to buy a $500,000 home with $4,000 in payment. But he doesn't make $4,000 a month. I mean, he makes $4,000 a month, but that's all he makes. If his payment for his house is $4,000 a month, there's no way that he can afford this house. Do you agree with me on that? Okay, so that's that. Now, the stated income program was coupled with the option arm or negative amortization loan. And let me explain you how that works. The negative amortization or the option arm, as we call them, you start with a teaser rate, what we call the teaser rate. It's a 1% interest rate. So your payment started at 1% interest rate. Then the second year it goes to 2%. The next year it goes to 3%. The next year it goes to 4%. The next year it goes to 5%. After 5 years, this loan is recast. That's what we call recasting. This loan is recast after 5 years at current market value for the interest rate. And now it's amortized over 25 years. Now, think about it. Excuse me. If your current interest rate for that mortgage was 5%, but your teaser rate at 1%, whatever happened to the other 4%? You know that the banks were paying more than that to the Federal Reserve, right? What happened to the other 4%? Here's where it gets tricky. The other 4%, the amount that you're not paying, gets added into your principal every single month. So let's say, for example, that your payment should have been at a 5% interest rate, should have been about $5,000 a month, but at 1% it's only $1,000 a month. That extra $4,000 gets added to your principal balance every single month. So for the next 5 years and so on. Now, let's say that the first month you started with a loan for $300,000, the next month you owe $304,000. And the next month 308, and the next month 312, and so on and so forth. At the end of the year, you're owing $40,000 more than you actually started with, and that's what they call a negative amortization loan. Now, where most people made money on the negative amortization loan at the beginning of this sequence is that they were purchasing the properties with a payment of $1,000 a month. Let's, as an example, just $1,000 a month. And then they were waiting for 8 months, 9 months, 10 months and reselling that property. When the market appreciation was at 89% per year, your property appreciated almost $100,000 in 6 months. Do you agree with me on that? You've seen the prices of the properties going up like by $30,000 every single month. I know that because as a homeowner, I remember that when I started looking for homes in 2002, the houses in my neighborhood were selling for $198,000, $198,000. I remember that exactly. That was in 2000 at the end of 2000. We wanted to bring 20% down payment because I always believed not paying PMI, so we started saving money. I told my wife we need to save money, bring 20% down payment, and we buy our home. By the end of the year, the following year, which is the beginning of 2002, okay, when we started looking for homes again, the properties were selling for $345,000. I mean, they went from $200,000 to $345,000 in just about a year and a half. Okay, it was crazy. And I told my wife at that moment, we really need to buy a house right now, because if we wait, the property values are going to skyrocket and we won't be able to afford the home anymore. So we ended up buying a home for $375,000 with 20% down payment. My house at a certain point, so I think I owed at the end of that, I owed like $330 or something like that, between $310 and $330. My property value went all the way to $625,000 in a matter of 4 years. $625,000. That's more than double, what we actually owed on the property. When the market flipped and the property values crashed, my property value went down to $315,000. Right now, my property value is around $345,000, $350,000. We owe about $310,000. So there's really nothing that I can do with my house right now. I can't even sell it. I can't refinance it. I can't do absolutely anything. You feel me? I feel your pain. We're in the same boat. I keep telling people that. Okay, so now, that's that. Now, where are we heading, though? Now, that's how we got there. Now, where are we heading? Let me explain you this chart really briefly, okay? In 2008, now, option arms and adjustable rate mortgages came in 3 packages. The first package is a package of 2-year fix. The next one is 3-year fix, and the next one is 5-year fix. For those of you who have been in the business before, you remember those days. You used to say 2-year fix, 3-year fix, 5-year fix. Those were standard, right? Now, the majority of the adjustable rate mortgages, the pinnacle, as you may say it, of the adjustable rate mortgages was in 2005. In 2005, when most of the adjustable rate mortgages were sold in the U.S., and they came in 2 years, 3 years, and 5 years packages. Now, if you consider that, in 2005, you add 2 years is 2007. 2007 was when the crash happened. And that happened because people started defaulting on their loans. Fannie Mae and Freddie Mac, as of December of 2008, Fannie Mae and Freddie Mac, they see a big increase of defaults on the market. And they start thinking to themselves, well, what's going on in the market right now? Because we see a lot of defaults going on. This was not happening a year ago. What do we do? So they took a month off. As a matter of fact, they took a month off. I think it was the month of June or July. They took a whole month off. They said, we're not funding any loans right now. We're doing an investigation. We're doing a survey, and we're analyzing the market to figure out why people are defaulting on their loans. As out of the end of that investigation, they came back and they say, you know what, we no longer do subprime because there's too much default and we foresee there's going to be more defaults on the market. That's exactly what happened now. So that was in 2007 when the defaults started. Then the 2-year adjustables started resetting, and then the 3 years adjustables started resetting in 2008. As a matter of fact, this chart here starts in 2008. In 2008, if you see the graph right here, this is $45 billion. This is not $45 million. This is $45 billion of adjustable rate mortgages resetting on the market in 2008. This combined with all this right here, you're talking almost about $1 trillion of adjustable rate mortgages resetting on the market in 2008. Okay, this is between August of 2008 and February 2009. And as you can see, the market trend decreases a little bit because these are the 3-year adjustables. Then it decreases on the 4th year. And then on the 5th year, which is August of 2010, you see a tremendous increase again of adjustable rate mortgages resetting on the market, recasting on the market once again. And you see this trending going like such, and you don't see a decreasing probably until August of 2012. So for those of you who do not like short sales and are not doing short sales because you don't like them, I think you better start loving short sales because they're going to be with us for a few years. Okay, that's my prediction. Now, I'm going to talk to you about the ripple effect. The ripple effect on the market, for those of you that don't know what that means. The ripple effect is the following. If you were investing in stocks in the market, let me give you an example. Let's say, for example, that you're investing in Microsoft, and Microsoft shares are selling for $50 a share right now. And then this morning, there's all over the news in the United States and all across the world that there's a new virus that is wiping out computers on Microsoft-based computers. What happens to the stock for Microsoft today? It automatically goes down, right? What happened to McAfee antivirus stock today? McAfee antivirus goes up, right? That is the ripple effect on the stock market. In real estate, we have the same thing. We have a ripple effect, but the ripple effect is a little bit longer than 1 day or even 2 days or even a month. It's actually more like 6 to 12 months. And I'm going to explain you the reason why. This is the process that I have seen people taking over and over and over again. I have seen people coming into my office and very distressed. They cry in my office. I've seen grown men cry, which is not a nice sight to see. Okay, and this is exactly what happened. Their loan recasted. That means that their interest rate went up. You know, they had probably an interest rate of 3%. It went up to 6% or something. I've seen payments go up from $3,000 a month to $5,000 a month from 1 month to the next. Okay, and this is exactly what happened. This is the process that most homeowners go through. Honey, we have to save some money because our payment is now higher, and we don't want to lose the house. So we want to keep the house. We want to save some money. So no more going out, no more clothes, no more movies, no more this, no more that, no more karate for the kids, etc., etc. We need to save money. Now they're still coming up short because nobody can go to their boss. If you're an employee, you cannot go to your boss and tell your boss, hey boss, I need a $2,000 raise per month and get away with it, okay, basically. So what happens is that they're still coming up short. They're still coming up short with that money. So what they start doing at that moment is that they start pulling out the difference. Let's call it the difference, okay? Whatever amount they're short, they're going to start pulling it out from credit cards. They say, well, honey, it's only $200. Don't worry. Next month we're going to make some more money and we're going to make it happen. And then the following month they don't have enough money again, and they start pulling up another $200. And then the next month it's $300, and the next month it's $500, and the next month it's $1,000, and so on and so forth. They start maxing out their credit cards to a point in which they have no more credit available, and now their payments on the credit cards start creeping up on them. So once they got rid of all the credit cards, they start taking money from their savings accounts, retirement accounts, 401ks accounts, life insurance, whole life insurance policies, etc., etc., etc. They start getting rid of all that money as well. Then after that, they start borrowing from friends and family. And once they finish with borrowing from friends and family, they finally come to a realization that they no longer can keep this home, and they start looking for help. And that's when basically they come to you, basically at that moment. Now, at this ripple effect, like I said before, this ripple effect is going to last a few months, because from the moment they start, pulling money from the credit cards, it's going to be 3 or 4 months before they run out of money on the credit cards, and another 3 or 4 months before they run out of money on the savings and checking account and retirement accounts and so on, and another 3 or 4 months until they start pulling money from friends and family and so on. So the ripple effect can last anywhere between 6 months to 12 months. So those loans that recasted in 2010, you're not going to feel the effect probably until the end of 2011. But then in 2011, you're going to see another surge of people losing their homes on the market in 2011, and then again in 2012, and then again in 2013. And I think this is going to last with us probably well beyond 2014, more than likely until 2015. So short sales are going to be here probably until 2015, and that's what my prediction is. And I think I'm right about that. Look at this article from in July 22nd in 2010 from Inman News. It says 8 million homeowners are currently not paying their mortgage, and we believe 6 million of them will lose their home to the bank in the next 2 years. 8 million homeowners are not making payments on their mortgage, and 6 out of 8 are going to lose their homes within the next 2 years. That's what it says. And this is 2010, so 2012, you see. And it says, according to a recent study, an additional 5 million homeowners are upside down in their home. 5 more million homeowners are upside down in their home. This suggests that 47% of all households in the U.S. are upside down. If you believe that these people will strategically default, this will push home ownership to even lower levels. 11 million people will default within the next 2 years. According to the statistics from the U.S. Treasury Department, anybody who purchased a home from 2004 to 2007, 30 to 45% of those homeowners are upside down, and I think the number is actually more than that. I think that's just very conservative. I think anybody who purchased a home between 2003 to 2007 is pretty much upside down, like 90% of the people, unless, of course, you brought a big down payment. All right, and some people did bring a big down payment, $200,000. They may not be upside down, but they have absolutely no equity on their home. Now, this is a chart that shows you how much the REO properties have grown over the last few years. and this is as of April of 2010. Now let me ask you a question, if you don't mind answering. Do you see this chart going up or going down? Going up. Going up. We haven't seen any decrease of bank-owned properties over the last few years. As a matter of fact, if anything, they're going to go up. Finding the solution to the crisis. So the government back in 2008, when all this crisis is going on, the government said to the investors, lenders, they said, well, you guys created this problem, now you have to find the solution to the problem. So the banks came and they said, well, let's put our minds together and let's find a solution. And they came up with three very creative programs. And the first one was called the HARP, the Home Affordable Refinance Program. The second one is called the HAMP, the Home Affordable Modification Program, which is this is the refinance program and this is the loan modification program, and of course the HAFA, the Home Affordable Foreclosure Alternative Program, HAFA. There are some other minor programs out there, but I'm not going to talk about those because they're not very popular and they don't work. Now, the HARP program started in 2008, and their mission was to help delinquent homeowners refinance their home, or those who will become delinquent to refinance their home. This program created incentives for lenders and investors for helping homeowners. Towards the end of this training, you will see some of the incentives that the banks are getting for participating in the program, and you will be really surprised and obviously upset about all the incentives that the banks are getting to sponsor these programs, basically. HARP, HAMP, and HAFA, 89% of services chose to participate in the program. That means that 9 out of 10 investors and banks decided to participate. All right? HARP refinance challenges. Now, the bank here is trying to refinance those properties. They came with this brilliant idea. They said, well, we are going to help people refinance their homes out of their option arm programs. Okay? But they found some problems. And the first problem was stated income programs, stated income loans. They would call the homeowner and say, sir, we're calling from your bank and we want to help you refinance your home into a 30-year fixed program so you don't have this negative amortization building up on your loan anymore, right? Then they go through the application and say, how much do you make per month? And now the guy who cuts the grass says, well, I make $3,000 or $4,000 a month. And then the guy is looking at the screen and he's like, well, your payment is $5,000 a month. I mean, how can you afford this? And they knew what they did, so it's not a surprise. Okay, it's not like they didn't expect this, right? So this was the first problem, because who in their mind is going to give a loan to somebody that can't afford it, right? So this is one of the big problems that they had. Unemployment. Some people lost their employment over the last few years, and that's not their fault, you know. And now they're unemployed, they don't have any reported income, and so on, and that's just not their fault. Reduced income goes along with unemployment. Already in default. Well, one of the rules, which I found kind of stupid, they say, well, we can help you refinance your home, but you don't have to be in default. Well, the people they were calling, they were already in default, so why are you calling me, basically? That's what I found silly. People that are underwater. Here's the thing. If you are upside down in your home and you issue a new loan, who are you going to sell it to? Nobody's going to buy you a loan that is upside down. Nobody's going to give you $500,000 for a mortgage that is only worth $350,000. You know what I'm saying? So that's one of the biggest problems too. And high ratios goes with low income. Lack of interest from most borrowers. Watch this. I come to you and I say, you have an option arm with a teaser rate of 2% right now. Your payment is $1,800 a month. We want to help you refinance the home into a fixed rate amortized over 30 years. And your payment is going to be $3,000 a month. What would you say to that? I mean, your payment right now is $1,800. Why would you want to refinance your home and make a payment of $3,000 a month? That doesn't make absolutely any sense, if you agree with me on that. So a lot of lack of interest from most borrowers and huge failure rate. Even for those people that actually could or took advantage of the refinance process, most of those people dropped out of the program. They say, well, the HARP refinance program is not working out. What do? We're going to find a better solution. And that's when they came over with the HAMP loan modification program. HAMP loan modification has exactly the same challenges. Unemployment, reduced income, high ratios, and high dropout ratios. This is the program we're going to talk about today. The HAMP refinance, I'm not going to touch it because nobody's doing it, honestly. I mean, in order to qualify for that program, less than 0.01% of the population is actually qualifying for that program. So we're not going to talk about it. The HAMP loan modification program is what we're going to talk about today. Loan modification statistics. U.S. Treasury Department as of November of 2010. That is last year. 6 million loan modification packages has been received. 6 million packages have been received by the investors or the servicing companies for loan modification. Out of 6 million, only 500,000 were actually approved. That number is staggering right there. That represents only 8% of all the loan modification packages that were actually submitted to the bank were actually approved. And out of the 500,000, a statistic from the Treasury Department, out of 500,000 people that were approved, 325,000 of them will default again in 6 months or less. 325. Only 3.5% of those modified will take advantage of a loan modification. 3.5% will be the only ones who will take advantage of the loan modification. By most part, the